Hey everybody, it's Brian Shannon from AlphaTrends.net. Today is Friday. It's the 1st of July, 2016. We got a 3-day weekend coming up, so that's good. And we had a heck of a week. It's not often that I look at the market and say, "Wow," but really, the S&P was up 3.2%, biotech's up 5.5%, and these bonds continue to soar. And it was looking like the end of the world at the beginning of the week. That's what the news headlines would have told us. But let's take a look at the action and make some sense here. The market started out the week, obviously, reeling from the Brexit exit, and then on Monday it gapped lower, and from there, here's a volume-weighted average price for the week. It gapped lower, and then on Tuesday, once we gapped up, we just saw a relentless continuation higher that's brought us all the way back up to the pre-Brexit move. So really, just an incredible week. I was looking at potential levels of resistance on the way back up, such as this volume weighted average price since Brexit. That, the market blasted right through that. It blasted right through that declining 5-day moving average. And that's why you always look at those levels only as potential levels of resistance. So we saw that let's take a look at the 30-minute time frame here, and we'll just back it up a little bit. We had broken what seemed like an important level of support that was likely to become resistance. However, there was absolutely zero resistance offered, which is why we always look at it as a potential level of resistance, and we don't look to sell short just because it has been prior support or Fibonacci level or whatever. And I was looking at these Fibonacci's like anyone else and thinking, well, maybe 61.8% is going to be the level. But at that point, even on that day, the volume weighted average price for that day, the market was still clearly above it and still rising. So as I say, when we have mixed messages from the market, you switch to the shorter term time frame and do not fight the direction of the volume weighted average price. So going into next week, it looks to me like we're likely to consolidate these gains a little bit. I think a lot of people are setting up short, looking for a deeper pullback, but right now we're kind of back into this range, and perhaps a slight pullback down towards the 50-day moving average, which actually is about 3 points away. So, or I'm sorry, 2 points away. If we were, to pull back down towards the 50-day moving average, I think that would be very healthy for the market, just to consolidate some of these gains. But you sure have to be impressed with what felt like and what was advertised to be, the end of this bull market. It really just roared right back, and now on the bigger time frame, we're still well within this bigger range that we've been involved in for better part of 2 years right now. So we're kind of back to the midpoint of this range in the S&P 500, and it continues to be a market where we're building energy for something, and that something could be a break to the upside. It certainly, we can look at this week now on the weekly time frame, as this was a flush out low earlier this year, and this is a higher low. So I think the 200 area, in that general area, is really where I would protect myself with stops if I was an investor, because breaking back below that I think would be an issue. But it looks poised to be able to continue to move higher here, not necessarily next week, because again, I think a pullback would be healthy, but it's built the energy, it's shaking people out, it's bringing in short sellers who scramble and look to buy back, and this is why we have this relentless buying here. We brought in a lot of short sellers here, and now they're paying the price. So there was ample opportunity to really have a bad week on both sides of the market, whether you were long or short. And during periods of indecision that are especially brought about by a macroeconomic event, it's best to just kind of ease off the gas pedal a little bit, play a stronger defense, and go on a stock by stock basis. And in Alpha Trends, we had some great stocks this week. But let's talk about the Nasdaq. The Nasdaq had been breaking down below this prior support level, and that support offered no resistance on the way back up, and we also blasted up through the declining 10-day moving average, through the 20 and the 50-day moving average. So Moving averages are great as reference points. They tell us where we want to look more carefully at the action on a shorter term time frame. So in here where we have that 20 and 50-day moving average, it says, okay, let's, the market's up a bunch. Let's see what happens in here. But it just blasted right through that level. There was zero evidence that the sellers were actually gaining control near that 20 and 50-day moving average. Now, for the NASDAQ, I think what we need to do is we need to see this area act as resistance next week. If this acts as resistance and we kind of float around in this area and then pull back even down towards 106 and a half, 107, we could start to rebuild and construct for the possibility that this market's ready to turn back around. And I think that, a shoulder, a head, and a right shoulder would, be what we would be looking for in this NASDAQ. And then we run the possibility that we could break beyond this downward sloping trend line here, which is really a band of resistance if you look at it properly. And we could be, by the end of the year, we could be up at new highs for the year. It's not unrealistic. When the market survives a shock like that, it makes it stronger. And now again, I think if I was an investor, I would use this as a very important level to measure against. Incidentally, here's our year-to-date volume-weighted average price in the NASDAQ, but in the S&P 500, that year-to-date volume-weighted average price was pretty much the absolute low for the S&P 500. I had pointed that out on StockTwits and Twitter. I wasn't suggesting buying there, but again, it's a level of interest, and it's interesting to see that it acted as it did back in February as pretty much the exact turning point after a little pullback in there. The Russell 2000 also had a great week. Let's just look at the numbers to refresh once again. Up 2.6%. They're positive by 2.5% year to date. So obviously they were down briefly year to date this week, but the year to date volume weighted average price is still well below where we ended up finding the support, and the support was found in this prior area where we've seen importance. So back below this band of support, I think changes things. I don't see that as a likely scenario, but it's something that a longer term investor would definitely want to consider as a place where you want to maybe lighten up if we get back down below there in the next several months, and in particular if we stay below it. But this is looking more and more like this has just been a big shakeout, and the market is behaving well. I think that the same thing here is that if we pulled back down towards the 50-day moving average somewhere in this range, that would be very healthy to help this market build some more energy. And don't forget, next week is a 4-day week. Semiconductors, they were out at new highs for the year. Prior to Brexit, they got smashed, and they've pretty much gotten back the majority of those gains. They suffered a little bit here today, but I think that's a healthy thing, just like the other markets. I think if we could see this market holding above 55, 75 to 56 on any further weakness, then this group, the semiconductors, I think just need some time to settle down in here. I don't think they have as much potential for upside as some of the other markets. Another thing I wanted to point out is, again, only price pays. You can talk about the volume in that, but only price pays. And the fact is, prices are holding up in here, and we've seen that oftentimes the inverse is what we see. We see increasing volume on the decline, and then complacent uptrends with declining volume. So in particular for the indexes, pay most attention to price action. In individual stocks, you can see the volume relationship much more clearly, how important it is, but not so much in the indexes. The biotechs found support in their area where they've been been down probing this year, but there's still a giant mess. I mean, we're back to the midpoint of the bigger range that we have here, and we've got a declining 20 and 50-day moving average. When we break it down to a 30-minute time frame, you can see that today we broke this little downtrend line, which represents the most recent trend lower. And I think that if this market were able able to now kind of just trickle back in here and spend some time in this area, that perhaps in the next week or two the biotechs are going to be ready to play catch up a little bit, still within a horrible decline, but I think that they can possibly continue. But I'd like to see some consolidation, some pullback price wise, some consolidation time wise before doing that. It's still not prudent to be chasing the market in either direction. It never is. I mean, once in a while you can get away with it, and you get bailed out of what is generally a foolish trade. But when you have this type of volatility, just remain patient. Let the opportunities come to you. Apple continues to be on the daily time frame a stock in trouble. It's right at the declining 20 and 50-day moving averages. Here's our year-to-date volume-weighted average price still overhead. So there's just better stocks than Apple to look at out there. The longer-term trend is still lower highs and lower lows below a declining 40-week or 200-day moving average. There's no reason to be early. Look back to 13. If you bought it in here, you had plenty of time to ride it up along that 200-day moving average, as you did over, back further in time. So it's still guilty till proven innocent. Maybe it's starting to show some signs of stability, but stability isn't what you want to buy. You want to buy as prices are going higher. Google looked like it was, maybe breaking down this week, and I think that, what you see here is a failed move, a failed breakdown, which leads to a faster move higher. If I was an investor, I would think that this is a very important level for Google now. It had that shakeout and it's recovering. It's back into a range, but still, it's it's looking much better than what looked like death. You just can't sell short and stay short because a stock breaks below a bearish flag. You've got to cover as it starts coming back up. And in the case of Google, you would have given back all your gains had you been short over there. So the bonds, the bonds have been just spectacular. They continue, and they are out actually at all-time highs for the TLT, which means yields are the lowest they've been since the TLT has been in existence as an ETF. And it just continues to show that there's a lot of fear and flight to safety in this market. Intermediate term traders, a worst case stop in bonds would be down near 137.5. It's still in an uptrend, and as they say, the fastest part of a move comes towards the end of the move. I wouldn't predict that this is the end of the move, but I would certainly be very careful. Bonds are not supposed to really move like this, and I would have a strategy for locking in some gains if you happen to be long bonds. Some of the stocks we were in this week, we were involved in KERX. We got involved in this one right as it started to get going over here. We're still involved in part of that. We were involved in MGT. Actually, a day before the move right over in here, we got out of some on the way up and got stopped out of the balance right there. And this is what we do every day, not necessarily make money every single day. TMH was one we were looking to sell short. It never triggered, so there's nothing lost on a stock like that. You've got stocks like RAX that we did short, over in this area, and we covered it as it went above this level over here. So taking a small loss is part of the plan. It's part of the business. It's not what you want to have happen, but it's certainly part of trading. And right now on Alpha Trends, I'm running a sale for annual subscriptions. If you follow me for a while, you know this doesn't happen often, but just the bronze level, for instance, which is $249 a year, is only $199 a year, and that gives you daily S&P 500, NASDAQ, Russell 2000, semis, Apple, and biotechs. The silver, which includes individual stock trading ideas, usually $5.99. It's only $4.99 for an annual subscription. And the gold that gives you all that, plus the live intraday chat room, is just $5.99. Normally $7.99. So these are all non-refundable, no trials. If you want a trial, if you want to see what Alpha Trends is all about, just go back in the blog archives. If it's at least 7 days old, there's no password required, and you should have a very good feel for what's there. I want to be involved with people who want to approach the market with a disciplined, consistent approach, regardless of what the headlines are, regardless of what the market conditions are. We're here to make money, and I think I can help you do that.